In the following videos, we're going to talk about the cost of capital. Very important topic, obviously, since companies need to gather funds. They need to have an understanding of what it's going to cost to gather these external funds. Now, it turns out that the cost of gathering money is directly related to the rate of returns that shareholders want. Said another way, shareholders want to receive a certain amount of return based on the riskiness they perceive of the stocks or the bonds. So therefore, they have a required return that they want. This required return must be paid by the corporation. Again, think about a bank, right? A bank tells a company it needs a certain rate of return, a certain interest rate in order to give a loan. The company has to pay that interest. They certainly wouldn't pay any more. And if they said, no, I don't want to pay 5%, I only want to pay 4%, they're not going to get the loan. So these two concepts, the rate of return on stocks and the costs of gathering stock funds, are directly related to each other. So in this chapter, we're going to talk about the different capital components, the concept of weighted average cost of capital, things that may affect the cost of capital, and then, of course, we're going to talk about how can we adjust this cost of capital for the riskiness of companies. This all falls into play with the formula for value. So this weighted average cost of capital, the cost of financing, has a direct influence on the value of the company. And there are certain obvious factors in the environment that have an impact on both the cost of debt and the cost of equity. So if we think about long-term capital, what were we talking about? Well, long-term debt, most companies have some of their short-term debt is reflective in a long-term format. So other companies will use temporary short-term debt for seasonal fluctuation. We will talk about this in some later chapters or videos, and we'll try to describe the concept, the strategies that management could use. But having said that, there are certain amounts of short-term assets that are financed with long-term debt. So that is part of this inclusion would be this anything long-term, by definition, is anything greater than a year. We'll talk about preferred stock, and we'll talk about common equity. So the capital components, again, are sources of funding. So accounts payable, accruals, deferred taxes, those aren't sources of financing, right? They are part of the operations of the company, but in reality, they're part of doing business, right? So we're going to adjust for these items when we talk about cash flows. But the cost of capital implies long-term sources of financing. We have to take into account taxes, obviously. So the tax effects associate certain kinds of financing tools. Well, let's not say certain kinds. The only one it does affect is debt, right? So most companies will use a variety of sources of financing, but the only source of financing that has influence on taxes and therefore net income is debt. So the calculations that we make, we will adjust the before tax cost of debt for taxes. but for the other sources, we will not. So we want to think of, do we want to look at historical costs or do we want to look at new costs, right? Do we want to look at things that we've already done or things that we want to do? And I think this makes a little bit of sense, but they're connected, right? So we have a capital structure that we have chosen. So we've chosen to gather our funds on a 40% debt, 60% equity. But the market has influence on those. So as prices change, the market values of those things change. Now, the accounting numbers don't change, but the market numbers change. And since we're thinking and proposing gathering future money, not money that we already have, we're looking to the future, we want to look at our current capital structure, we want to look at its market values, and then we want to apply the costs based on current financing. So, long story short, we need to use market values when we're thinking about capital structure and the cost of gathering new money. So there are three basic ways we can look at the cost of debt. We could ask an investment banker what coupon there would be on the new debt. Now, when we issue new debt, we want the coupon to be as close to the market rate as possible. The reason we want this is because if the coupon rate is exactly equal to the market rate, we would be able to gather the full value of the bond, its face value of $1,000. Now, by the time the bond actually gets issued, there could be some differences, but typically you wouldn't think big differences, right? We might be 0.5% off, up or down, depending on what's happening in the marketplace. But over a 1-year period, you wouldn't think normally that interest rates would change, certainly not much more than 1%. Another way we could do this is we could find the bond rating for the company and then use the yield on other bonds with similar rating. We can look this up in it's called FRED. It's a federal database that's part of the St. Louis Federal Reserve. And we can look up, say, what's AAA rated corporate bonds? What are they? Or what is that? What do they look like? And it will give us data about them. But the most important thing they might give us in this context is they would tell us the average rate of return on a AAA rated corporate bonds. The assumption here is all things that are equally risky in the bond world should provide the same level of return because risk and return are tied together. And finally, if the company has its own debt, we could find the yield on its own debt and use that number because that number today reflects what people are paying today for the debt of the company. Now, this becomes difficult for some companies because they have such huge amounts of debt. So again, these are three methods. Each one of them has their advantages, disadvantages, if you will, but we're going to look at several of them. So first of all, we need to remind ourselves that interest is tax deductible. So whatever the before tax cost is, for instance, if the before tax cost or the yield of debt is 10%, and we have a 25% tax bracket, the after-tax cost is actually 7.5%. For bonds, the flotation cost is usually pretty small, so If we want to, we could ignore it or we could include it. It really doesn't matter. But here's an Excel spreadsheet where we could incorporate this information, right? So the coupon of this bond is 12%. It's a 15-year bond. The price of this bond is $1,153.72. Now, in this case, again, we said, the flotation cost is very low, so we're not going to include it here. But if we did include it, we would want to put in here the actual dollar per bond flotation cost. The tax rate of the company is 25%, and the bond's par value, of course, is $1,000. So the before tax cost on this debt is 9.98%. Now that's the before tax. When we include taxation, the after-tax cost, calculated down below here, 7.49%. Okay, so we find out what? 9.98, roughly 10%, is the before-tax cost. After we take into account taxes, the company essentially only pays 7.49%. Now let's move on and think about preferred stock. The price of our preferred stock is $116.95. It's a 10% coupon. Par value is $100, and the flotation cost is 5% of the price. Now we can just use this formula. Take the dividends divided by the price times 1 minus flotation cost. By the way, this is what's referred to as the net price, right? If we have to incorporate flotation costs, we don't want to use the market price. We want to use the flotation, the net price in our calculation. And again, it turns out roughly 9%. So again, as I mentioned, flotation costs for preferred can be significant, so we want to include them. Preferred dividends are not deductible, so there's no tax adjustment. So the before tax and the after tax are the same. What we're going to find out, sorry about that typo there, it is preferred stock more or less risky to investors than debt? It is riskier because the company is not required to pay the dividend. However, companies want to pay this preferred dividend. If they don't pay the dividend, they cannot pay common dividends. It might be difficult to raise additional funds. And of course, there could be things in the preferred stock contract that would allow preferred stockholders, to gain some control of the company. So is it more riskier than debt? And the fact here is that it is more risky because they don't have to pay the dividend. The dividend is at risk. So when we plug into our worksheet, $10 dividend, $116.95 is the price. Now the flotation cost is in dollars. So this is actually a formula. So 5% of $116.95 is this $5.85. The before tax cost is 9%. And of course, there's no taxation, so the after tax is 9%. So a question we have here is, why is the yield of preferred lower on R sub D? Why is the before tax yield the before tax yield on preferred stock, why is it lower than the before tax cost of debt? And the reason for this is that corporations are the people that own the most preferred stock. And they own this because they get a 50% reduction is non-taxable to the corporation. If you remember, we've talked about this in previous videos. So the preferred is often going to have a lower before tax yield than the before tax yield on debt. But when you look at the after tax cost, because taxes are help reduce the overall cost of debt, we get into the thing that looks more consistent to us, that the after tax cost of debt is less than the after tax cost of preferred. Look forward to seeing you in the next video.